Hello, and welcome to this episode of BullionStar Insights, in which we will look at the escalating banking crisis, its growing contagion, and ask whether what we are seeing right now is just the tip of the iceberg. Now, you'll probably be familiar with the names Silvergate Bank and Silicon Valley Bank, both of California, as well as Signature Bank of New York, all three of which collapsed rapidly during the first half of March of this year. While all three of these banks could be considered crypto-friendly and were involved in the crypto sector, that's not why they collapsed. These banks collapsed because the US Fed rapidly increased interest rates, and the assets in which these banks primarily had invested in, i.e. low yield fixed income bonds, deteriorated in value. At the same time, there were huge depositor withdrawals, i.e. bank runs from these banks. So you'll recall that the US Fed raised interest rates a massive 9 times between March of last year and March of this year, and again a 10th time on the 3rd of May this year. They literally took the official Fed interest rate from near zero to over 5%. While US regulators allowed Silvergate Bank to liquidate on March the 10th, a joint operation by the US Treasury, Fed and FDIC on March the 12th seized both Silicon Valley Bank and Signature Bank, guaranteeing all of their deposits and calling both of these banks systemic risk exceptions. At the same time, the Fed, Treasury and FDIC released a joint statement saying that the US banking system was resilient and on a solid foundation. But US financial markets, not believing this, continue to hunt for the next failed bank victim by analysing the asset values of all US banks and the composition of their uninsured depositors. The next victim that they actually found was an even bigger bank failure in the form of First Republic, also of California, which failed formally on the 1st of May and was taken over by JP Morgan. In fact, First Republic is the second largest bank failure in the US of all time, behind Washington Mutual of 2008. And Silicon Valley Bank and Signature Bank are the third and fourth largest US bank failures of all time. So literally, within a 2-month period between March and May 2023, we have seen 3 of the 4 largest US bank failures of all time. So how is that for a resilient and solid US banking system? So this poses the question, which other bank failures are on the horizon? So to predict the future, it's instructive to look at US bank crises of the past to see how these crises flared up, and importantly to appreciate that a lot of bank failures during these crises took place and snowballed actually far after what was perceived to be the peak of that crisis. So if we look at the 1980s US banking crisis, which was known as the savings and loan crisis, over 1,000 savings and loan institutions failed and went bust. And this was triggered mainly by the US Fed raising interest rates to tackle inflation, very similar to now. A lot of the S&Ls at that time were lending at low fixed rates, but as interest rates rose, they had to begin offering their customers higher interest rates on deposits. This encouraged them to take extra risks on their loans, and they became more and more involved in the commercial real estate sector, a bubble which eventually burst, and this caused a huge amount of S&Ls to become insolvent. But interestingly, in the S&L crisis, the Fed had been hiking all the way from mid-1985, all the way through 1986 and into 1987. But the majority of S&L failures only took place between 1987 and 1989, as the economic effects of higher interest rates took effect. For example, while there were only 5 S&L failures in 1985 and 42 in 1986, there were 206 in 1987, 176 in 1988, and 87 in 1989. So the key point here is that in 1985, it didn't look like there was an S&L crisis because the S&L failure momentum hadn't got going. So there was a delayed effect of S&L failures in the 1980s. This is also true of the US banking crisis, which began in 2008, that there was a delayed reaction before a critical mass of banks failed in 2009 onwards. A lot of people remember the great financial crisis, which is attributed to the years 2007, 2008, and possibly 2009. This is when a lot of big name institutions went bust. For example, you might remember Northern Rock failed in September 2007, then there was Bear Stearns failing in March 2008, then IndyMac, large S&L, had to be taken over by the US government in July 2008. Then the big one, Lehman's, failed in September 2008. Merrill Lynch had to be taken over by Bank of America, also September 2008. AIG had to be bailed out by the US government. Then there was also Washington Mutual, which went bust. and there was Wachovia taken over by Wells Fargo in October 2008, and Citibank during this time had to be rescued a number of times by the US government. In the case of the financial crisis of 2007 and 2008, the associated banking crisis which emerged at that time wasn't caused by higher interest rates, but was caused by the bursting of the subprime mortgage market and a huge use of mortgage securitization. It was also exacerbated by the interconnectedness of markets compared to the 1980s, the huge use of derivatives compared to the 1980s, and also massive counterparty risk, which wasn't around in the 1980s. But there was some warning signs in 2007 that the banking crisis might have been on the horizon. For example, credit markets started freezing over, banks suffered funding problems, and the subprime market began to keel over with some delinquencies and defaults. But still, according to the FDIC, in 2007, there were only 3 bank failures. In 2008, there were only 28. But then things really got going in 2009, when there were 140 bank failures. In 2010, 157. In 2011, there were 92, and in 2012 there were 51. So over the 2009 to 2012 period, there were 440 bank failures, which was 17 times more than the 28 bank failures which took place in 2008. So the key point here again is that in 2007 and in 2008, there really wasn't much evidence that there was a banking crisis on the horizon because it hadn't yet gained momentum. It really gained momentum from 2009 onwards, when the effects of the end of 2007 to 2009 official recession took effect. And so again, we can see the parallel with the 1980s, that there is a delayed reaction in bank failures after a crisis looks like it might have passed. Turning back to the current day, what's the main lesson we can learn from previous US banking crises? Well, the main lesson is that what can start off as a few failed banks can quickly snowball into something much larger. All the while, governments and regulators will say that it's a contained issue and a localized flare-up. For example, on 22nd of March, Fed Chair Jerome Powell said that the US banking system was strong and resilient. But less than a month later, First Republic failed, and other regional banks such as PacWest are now in the firing line. More recently, on the 9th of May, in a speech in New York, the New York Fed President John Williams said that the US banking problems were just a few troubled financial firms which are not representative of the US banking industry. But he would say that because that's his job. However, a group of financial academics in the US begs to differ with Powell and Williams. In March of this year, the group from Stanford, Columbia, Northwestern and the University of California did a study which shows that 186 banks in the US are at risk of impairment if 50% of their uninsured depositors withdraw their funds. This could also cause a potential $300 billion loss on insured deposits of these banks due to the nature of the assets that they have invested in, which have made losses, i.e. low yield fixed income bonds. So this sort of news could create a scenario of a bank run unless the government intervenes. Banks have been calling on the FDIC to increase the deposit insurance limit on insured deposits. Currently it stands at $250,000 per person. But where would the FDIC get this funding to cover increases in the deposit insurance? Given the ongoing problems with the US regional banking sector, there's a growing trend right now of deposits flowing out of these US regional banks and into the large US megabanks, such as Citibank, Bank of America, JP Morgan Chase, and Wells Fargo. The perception being that these large banks are far safer. But is this perception actually true? Not if there is systemic risk. A loss of confidence, a contagion fear, or bank runs can snowball overnight and cause systemic risk. And if there is systemic risk in the US banking sector, this will instantly spread to the European banking sector, not to mention the failure and bailout of Credit Suisse by UBS recently. There's also the problem with smaller US banks now perceived as being vulnerable because deposits are fleeing, so they now will have a higher cost of funding. So they are more vulnerable to being taken over, and there is ample room for consolidation in the US banking industry, seeing that there are still over 4,000 distinct banks. So consolidation is another one of the consequences of what's happening right now. Also, the problem that arose from the Fed raising interest rates is an interest rate risk problem. So the banks that have had problems so far are experiencing an interest rate risk problem. But this could morph quite easily into a credit risk problem, like the way there was credit risk in the 1980s saving and loan industry and in the 2008 US banking crisis. Because if consumer loans and residential mortgages keel over and defaults rise, the exposure of the US banking sector could go from an interest rate risk to a credit risk. A US recession will also undermine bank lending portfolios due to higher debt repayment problems, and higher default rates, hence more bank failures. At the end of the day, there is one simple reason why bank crises exist, and that is because modern day commercial banking is fractional reserve banking. In fractional reserve banking, banks never have enough reserves to pay all depositors at once. And especially in a financial crisis, when depositors actually all want to be paid at the same time, banks don't have enough liquid assets to do this. This is made worse by the duration mismatch between the bank's long-term assets and short-term liabilities. What a lot of depositors putting money in the bank forget is that when they put this cash into a bank, it is literally gone. You do not have a claim on that actual cash. You only have a claim for an equivalent amount with the counterparty, the bank. This creates counterparty risk and default risk. Fractional reserve banking is also the exact opposite to buying and storing physical gold and silver, either in your possession or in a third-party non-bank vault. When you buy and store physical precious metals, there is no counterparty risk or default risk for the simple reason that there is no counterparty. So I hope you like this BullionStar Insights video about the escalating banking crisis. Be sure to like the video, share it with your friends, even make some comment below, and subscribe to our YouTube channel. Thank you.